Real estate math can be one of the most challenging parts of the exam, especially when questions are designed to test more than just formulas. In this video, you'll tackle tough questions on topics like financing and loans, closing and settlement, and property valuation. And don't miss what's happening in the bottom corner. It's designed to supercharge your exam prep. We'll explain more in just a minute. Let's dive in and get started.
Real estate math. Basic math concept. A real estate agent calculates the commission on a property sale of $250,000 at a rate of 6%. What is the total commission amount? Is it A, $12,500, B, $18,000, C, $15,000, or D, $16,000? The answer is C, a total amount of $15,000. Why this may seem tricky? The question includes a simple percentage calculation that might be overlooked. To find the commission, multiply $250,000 by 0.06, resulting in $15,000. This is a straightforward calculation, but the presence of similar numbers could cause confusion. If a property is sold for $500,000 and the seller pays a 5% commission, how much does the seller receive after paying the commission? Is it A, $25,000, B, $475,000, C, $500,000, or D, $450,000? The answer is B, a total amount of $475,000. Why this may seem tricky? The question requires subtracting the commission from the sale price, not just calculating the commission. The commission is $25,000, so the seller receives $475,000 after paying the commission.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
A property is listed at $300,000. If it sells for 10% less than the listing price, what is the sale price? Is it A, $30,000, B, $330,000, C, $300,000, or D, $270,000? The answer is D, $270,000. Why this may seem tricky? The question involves a percentage decrease requiring subtraction from the original price. A 10% reduction from $300,000 results in a sale price of $270,000. A buyer offers $200,000 for a home. If the seller counters with a price that is 15% higher, what is the counter-offer price? Is it A, $200,000, B, $230,000, C, $215,000, or D, $250,000? The answer is B, $230,000. Why this may seem tricky? The question involves calculating a percentage increase. A 15% increase on $200,000 results in a counteroffer of $230,000. The presence of similar numbers could lead to miscalculation. A property appreciates by 20% over 1 year. If its original value was $150,000, what is its new value? Is it A, $180,000, B, $170,000, C, $150,000, or D, $200,000? The answer is A, $180,000. Why this may seem tricky? The question involves calculating a percentage increase from the original value. A 20% increase on $150,000 results in a new value of $180,000. Misreading the percentage or the operation could lead to errors. A real estate investor buys a property for $200,000 and sells it for $250,000. If the investor's expenses total $15,000, what is the net profit? Is it A, $50,000, B, $35,000, C. $30,000, or D. $40,000? The answer is B. $35,000. Why this may seem tricky. The question includes unnecessary expense details that might mislead you. The net profit is calculated by subtracting the purchase price and expenses from the sale price, resulting in $35,000. Real estate transactions. A property is sold for $250,000 with a 6% commission rate. If the commission is split equally between the buyer's and seller's agents, how much does each agent receive? Is it A. $15,000, B. $7,500, C. $12,500, or D. $9,000? The answer is B. $7,500. Why this may seem tricky. The question involves calculating percentages and splitting them, which can confuse test takers. The total commission is $15,000, 6% of $250,000, and each agent receives half, or $7,500. A buyer agrees to purchase a home for $300,000 with a 20% down payment. What is the mortgage amount? Is it A. $60,000, B. $300,000, C. $180,000, or D. $240,000? The answer is D. $240,000. Why this may seem tricky. The question requires understanding of down payments and mortgage calculations. The down payment is $60,000, 20% of $300,000, so the mortgage amount is $240,000. If a property appreciates by 5% annually, what will be its value after 2 years if it's currently worth $200? Is it A. $210,000, B. $215,000, C. $220,500, or D. $230,000? The answer is C. A total amount of $220,500. Why this may seem tricky. Compounded appreciation requires calculating each year's increase separately. After the first year, the value is $210,000. After the second year, it's $220,500. Which of the following is not a typical closing cost in a real estate transaction? Is it A. Homeowners association fees, B. Title insurance, C. Appraisal fees, or D. Recording fees? The answer is A. Homeowners association fees. Why this may seem tricky. The question includes common terms that may confuse. Homeowners association fees are ongoing costs, not closing costs like title insurance, appraisal fees, or recording fees. A seller wants to net $200,000 from their home sale after paying a 5% commission. What should be the minimum listing price? Is it A. $190,000, B. $2.26, C. $200,000, or D. $205,000? The answer is B. $210,022. Why this may seem tricky. Sellers often forget to account for the commission in their desired net amount. To net $200,000 after a 5% commission, the listing price should be $210,526.32.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
A property is listed at $400,000 and sells for $390,000. If the buyer's agent receives 3% of the selling price, how much commission does the buyer's agent earn? Is it A. $12,000, B. $11,700, C. $11,500, or D. $10,000? The answer is B. A total amount of $11,700. Why this may seem tricky. The listing price is irrelevant for calculating commission, which is based on the selling price. The buyer's agent earns 3% of $390,000, not $400,000. A homeowner paid $15,000 in property taxes this year. If their property tax rate is 1.5%, what is the assessed value of their home? Is it A, $1,500,000, B, $1,050,000, C, $1 million, or D, $900,000? The answer is C, $1 million. Why this may seem tricky: the property tax rate is often misapplied. Divide the tax paid by the rate, 0.015, to find the assessed value, which is $1,000,000. If a property is purchased for $500,000 with a 10% discount, what is the final purchase price? Is it A, $450,000, B, $490,000, C, $475,000, or D, $500,000? The answer is A, $450,000. Why this may seem tricky: discounts are subtracted from the original price. The final price is $500,000 minus 10% of $500,000, which equals $450,000. Property valuation and investment. A property has a net operating income of $50,000 and a capitalization rate of 5%. What is the estimated value of the property? Is it A, $500,000, B, $250,000, C, $1 million, or D, $10,000? The answer is C, $1 million. Why this may seem tricky: the capitalization rate is often confused with a percentage calculation. The value is determined by dividing the NOI by the capitalization rate. The correct calculation is $50,000 per $0.05,000. Which of the following is not considered when calculating the gross rent multiplier? Is it A, property price, B, gross annual rental income, C, rental income, or D, operating expenses? The answer is D, operating expenses. Why this may seem tricky: the GRM calculation involves rental income but not operating expenses. GRM is calculated by dividing the property price by the gross annual rental income, excluding expenses. If a property's value appreciates at a rate of 3% annually, how long will it take for the property to double in value? Is it A, 24 years, B, 36 years, C, 12 years, or D, 18 years? The answer is A, 24 years. Why this may seem tricky: the rule of 72 is often overlooked. By dividing 72 by the annual appreciation rate, 3%, it takes approximately 24 years for the property value to double. Which of the following statements about the internal rate of return is false? Is it A, IRR assumes reinvestment at the same rate, B, IRR is used to evaluate the profitability of investments, C, IRR can be used to compare different investments, or D, IRR is the average rate of return over the investment period? The answer is D, IRR is the average rate of return over the investment period. Why this may seem tricky: IRR can be confused with simple interest calculations. IRR is the interest rate at which the net present value of cash flows equals 0, not the average rate of return. A property is purchased for $200,000 and sold for $300,000 5 years later. What is the average annual rate of return? Is it A, 5%, B, 8.45%, C, 10%, or D, 15%? The answer is B, 8.45%. Why this may seem tricky: the average annual rate of return is not simply the profit divided by the number of years. The correct calculation involves the compound annual growth rate, which is approximately 8.45% in this scenario. A property generates a monthly rental income of $2,500 and has operating expenses of $600 per month. If the capitalization rate is 6%, what is the estimated value of the property? Is it A, $400,000, B, $380,000, C, $300,000, or D, $500,000? The answer is B, $380,000. Why this may seem tricky. The question contains monthly figures, but valuation requires annual figures. Convert monthly income and expenses to annual figures before applying the capitalization rate formula. Which of the following is not a factor when calculating the internal rate of return for a real estate investment? Is it A, initial investment cost, B, projected cash flows, C, investor's personal tax rate, or D, timing of cash flows? The answer is C, investor's personal tax rate. Why this may seem tricky. IRR calculations involve cash flow and timing, but not the investor's personal tax rate. Tax implications are separate from IRR calculations. If a property is purchased for $150,000 and later appraised at $180,000, what is the percentage increase in value? Is it A, 20%, B, 25%, C, 15%, or D, 30%? The answer is A, 20%. Why this may seem tricky. The question involves a straightforward percentage increase calculation, but the distractors are close in value to catch careless errors.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Financing and loans. A borrower takes a loan of $200,000 at an annual interest rate of 5% for 30 years. Which of the following is not a factor that will affect the monthly payment amount? Is it A, loan term, B, interest rate, C, closing costs, or D, principal amount? The answer is C, closing costs. Why this may seem tricky. The question asks for a factor that does not affect the payment, which can be overlooked. Loan term, interest rate, and principal amount affect payments. Closing costs do not change monthly payments. If a property is purchased for $300,000 with a 20% down payment, what is the loan amount? Is it A, $60,000, B, $240,000, C, $300,000, or D, $360,000? The answer is B, $240,000. Why this may seem tricky. The question is straightforward but can confuse if one miscalculates the down payment. A 20% down payment on $300,000 is $60,000, leaving a loan amount of $240,000. Which of the following will decrease the total interest paid over the life of a fixed-rate mortgage? Is it A, making extra principal payments, B, increasing the loan term, C, refinancing to a higher interest rate, or D, reducing the loan amount? The answer is A, making extra principal payments. Why this may seem tricky. The question uses decrease and options could confuse. Making extra payments reduces principal faster, decreasing total interest. Other options don't impact interest paid. A borrower is considering two loans, one with a lower interest rate and higher closing costs, and another with a higher interest rate but lower closing costs. Which factors should they consider to minimize total loan cost? Is it A, loan term, B, down payment, C, monthly payment, or D, interest rate? The answer is D, interest rate. Why this may seem tricky. The question requires evaluating long-term costs. Total interest paid over the loan's life often outweighs initial closing costs, making interest rate a crucial factor. A borrower has a 15-year fixed-rate mortgage. Which of the following statements is false regarding the impact of making additional principal payments? Is it A, they can reduce the loan term, B, they lower the total interest paid, C, they change the interest rate, or D, they increase equity in the property? The answer is C, they change the interest rate. Why this may seem tricky. The question asks for a false statement, which can be overlooked. Additional payments reduce interest and loan term, but do not change the interest rate. A borrower takes a $250,000 loan at 4% annual interest for 30 years. Which of the following will not affect the total interest paid over the life of the loan? Is it A, loan term, B, annual interest rate, C, borrower's credit score, or D, loan amount? The answer is C, borrower's credit score. Why this may seem tricky. The question includes similar-sounding options that could confuse. The total interest is affected by loan amount, interest rate, and loan term, but not by the borrower's credit score. The credit score affects loan eligibility and interest rate, but not the interest calculation itself. If a property is appraised at $350,000 and the lender offers a loan-to-value ratio of 80%, what is the maximum loan amount? Is it A, $350,000, B, $280,000, C, $70,000, or D, $300,000? The answer is B, $280,000. Why this may seem tricky. The options include calculations that appear correct at first glance. The maximum loan amount is calculated by multiplying the appraised value by the loan-to-value ratio, which is $280,000 in this case. Which of the following would not reduce the monthly mortgage payment on a fixed-rate loan? Is it A, increasing the loan term, B, refinancing to a lower interest rate, C, making a larger down payment, or D, paying extra towards principal? The answer is A, increasing the loan term. Why this may seem tricky. The options include actions that affect total loan cost, but not necessarily monthly payments. Increasing the loan term reduces monthly payments, but increases total interest paid.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Taxes and assessments. If a property's assessed value is $200,000 and the tax rate is 2.5%, what is the annual property tax? Is it A, $4,000, B, $5,000, C, $5,500, or D, $10,000? The answer is B, $5,000. Why this may seem tricky. The question uses percentages, which can lead to calculation errors. The property tax is calculated by multiplying the assessed value by the tax rate. Therefore, $200,000 multiplied by 0.025 equals $5,000. A property was assessed at $300,000 last year with a tax rate of 1.2%. This year, the assessed value increased by 10%, but the tax rate decreased to 1%. What is this year's property tax? Is it A, $3,000, B, $3,600, C, $3,300, or D, $960? The answer is C, $3,300. Why this may seem tricky. The question involves multiple changes, leading to potential confusion. The new assessed value is $330,000, 10% increase, and the tax is $330,000 times 1%, 0.01, totaling $3,300. Which of the following statements about tax liens is not correct? Is it A, tax liens are involuntary liens, B, tax liens can lead to foreclosure, C, tax liens have priority over most other liens, or D, tax liens are always voluntary? The answer is D, tax liens are always voluntary. Why this may seem tricky. The question uses a negative, which can easily be overlooked. Tax liens are prioritized over most other liens, are involuntary, and can lead to foreclosure if unpaid. A homeowner's property is assessed at $250,000, and the local tax rate is 1.5%. If the homeowner qualifies for a $50,000 homestead exemption, what is the property tax owed? Is it A, $3,000, B, $3,750, C. $3,500, or D. $4,500? The answer is A. $3,000. Why this may seem tricky: the presence of an exemption can be overlooked. Subtract the exemption from the assessed value, then apply the tax rate. $250,000 to $50,000 x 1.5% equals $3,000. A property is assessed at $400,000 with a tax rate of 1.75% and a special assessment of $500. What is the total amount of taxes and assessments owed? Is it A. $6,500, B. $7,000, C. $7,250, or D. $7,500? The answer is D. $7,500. Why this may seem tricky: the special assessment must be added to the tax amount. Calculate the tax, $400,000 that was 1.75%, and add the $500 assessment for a total of $7,500. A property is assessed at $350,000 with a tax rate of 1.8%. If the city offers a 10% early payment discount, what is the discounted tax amount? Is it A. $6,300, B. $6,000, C. $5,670, or D. $5,850? The answer is C. A total amount of $5,670. Why this may seem tricky: the question includes an early payment discount, which may be overlooked. The annual tax is $6,300, and the 10% discount reduces it to $5,670. A homeowner's property is assessed at $500,000. The local tax rate is 2% with a $100,000 exemption. What is the tax amount owed? Is it A. $10,000, B. $8,000, C. $9,000, or D. $75? The answer is B. $8,000. Why this may seem tricky: the exemption must be subtracted before applying the tax rate. The taxable value is $400,000, resulting in a tax of $8,000. A property is assessed at $450,000 with a tax rate of 1.5%. If there's a $1,000 special assessment, what is the total tax and assessment owed? Is it A. $7,750, B. $6,000, C. $8,000, or D. $7,500? The answer is A. A total amount of $7,750. Why this may seem tricky: the special assessment must be added after calculating the property tax. The property tax is $6,750, and the total including the assessment is $7,750.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Closing and settlement. A property sells for $250,000. The seller pays a 6% commission to the real estate agent and $5,000 in closing costs. What is the seller's net profit? Is it A. $225,000, B. $235,000, C. $230,000, or D. $240,000? The answer is C. $230,000. Why this may seem tricky: the question includes multiple costs, and it's easy to overlook one. To find the net profit, subtract both the commission and closing costs from the sale price. A buyer purchases a home for $300,000 with a 20% down payment. If closing costs are 3% of the purchase price, what is the total amount the buyer must bring to closing? Is it A. $60,000, B. $9,000, C. $69,000, or D. $69,000 plus $60,000? The answer is D. $69,000 plus $60,000. Why this may seem tricky: the question requires calculating both the down payment and closing costs separately. Add these to find the total amount needed at closing. Which of the following is not typically included in the closing costs for a buyer? Is it A, homeowner's insurance premium, B, appraisal fees, C, title insurance, or D, loan origination fees? The answer is A, homeowner's insurance premium. Why this may seem tricky, the question uses negative wording, asking for what is not included. Loan origination fees are usually part of closing costs. A property is sold for $400,000. The buyer pays a 10% down payment and the lender charges 2 points at closing. How much are the total points paid? Is it A, $8,000, B, $7,200, C, $4,000, or D, $6,000? The answer is B, a total amount of $7,200. Why this may seem tricky, the question includes a down payment detail that is irrelevant to calculating points. Points are calculated on the loan amount, not the sale price or down payment. The loan amount is $360,000, 90% of $400,000, and 2 points equal 2% of $360,000, which is $7,200. A seller receives $220,000 after paying off a $180,000 mortgage and $10,000 in closing costs. What was the original sale price? Is it A, $400,000, B, $390,000, C, $410,000, or D, $360,000? The answer is C, $410,000. Why this may seem tricky, the question structure may lead to confusion between net proceeds and sale price. The sale price includes the mortgage payoff and closing costs. Adding back the mortgage and costs gives $410,000 as the sale price. A buyer is purchasing a home for $500,000 with a 15% down payment. If the closing costs are 4% of the loan amount, what are the total closing costs? Is it A, $20,000, B, $22,500, C, $15,000, or D, $17,000? The answer is D, $17,000. Why this may seem tricky, the question requires calculating closing costs based on the loan amount, not the purchase price. The loan amount is $425,000, 85% of $500,000, so 4% of $425,000 is $17,000. Miscellaneous calculations. A property is listed for $250,000 and the buyer offers 90% of the asking price. If the seller agrees to pay 3% of the sale price in closing costs, what is the net amount the seller receives? Is it A, $225,000, B, $217,500, C, $243,750, or D, $218,250? The answer is D, $218,250. Why this may seem tricky, the question involves multiple steps, including calculating percentages and understanding net proceeds. The seller receives $225,000, 90% of $250,000, less 3% in closing costs, $6,750, totaling $208,250. A real estate agent earns a 5% commission on the first $100,000 of a property's sale price and 2% on any amount over $100,000. What is the total commission on a $150,000 sale? Is it A, $5,000, B, $6,000, C, $7,500, or D, $3,000? The answer is B, $6,000. Why this may seem tricky, the tiered commission structure requires separate calculations for different portions of the sale. The commission is $5,000 for the first $100,000 and $1,000 for the remaining $50,000, totaling $6,000. A property is assessed at $200,000 with a tax rate of 1.5%. If the assessed value is reduced by 10%, what is the new annual property tax? Is it A, $2,700, B, $3,000, C. $2,850. Or D. $2,970. The answer is A. $2,700. Why this may seem tricky, the question involves a reduction in assessed value and recalculating taxes. The new assessed value is $180,000, resulting in a tax of $2,700, 1.5% of $180,000. A homeowner wants to refinance their mortgage. They have an outstanding balance of $180,000 and want to add $10,000 for renovations. If the new loan has a fixed rate of 3% over 30 years, what is the total interest paid over the life of the loan? Is it A. $54,000, B. $72,000, C. $92,038, or D. $102,000? The answer is C. $92,738. Why this may seem tricky, the calculation involves adding renovation costs to the loan and using the amortization formula. Total interest is approximately $92,738. This requires understanding of loan amortization and interest calculations. An investor buys a property for $300,000 and expects to sell it for $360,000 after 5 years. If the investor wants a 10% annual return, what should be the minimum rental income per year? Is it A. $20,000, B. $25,000, C. $28,000, or D. $30,000? The answer is D. $30,000. Why this may seem tricky, the question involves calculating expected returns and rental income. The investor needs $30,000 annually to achieve a 10% return, considering the sale price and initial investment. A property is valued at $400,000, and the owner wants to sell it at a 15% profit after paying 6% in selling costs. What should be the listing price? Is it A. $460,000, B. $480,000, C. $487,044, or D. $500,000? The answer is C. $487,234.04. Why this may seem tricky, the question includes both profit and costs, which can confuse the calculation. The correct listing price is $487,234.04, calculated by dividing the desired profit-inclusive price by 1 minus selling cost percentage.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.